This is Duke University.
So welcome, good evening, and welcome to the CASE Initiative on Impact Investing Speaker Series. Normally Matt Nash, who is the Executive Director of CASE, would come tell you about CASE, but he is happily out on paternity leave with the birth of his second child. So let me welcome you warmly in his place. CASE is the Center for the Advancement of Social Entrepreneurship, and we are a research and education center here at the Fuqua School of Business at Duke that prepares leaders and organizations to create change. We are celebrating our 10th anniversary later this fall, and last fall in September we launched our new initiative focused on impact investing, which we hope to be an exciting addition to our next 10 years of work. I'm Kathy Clark. I'm a faculty member here at CASE, and I'm also the director of CASE I3, our initiative in impact investing. There's been a great deal of interest and activity around the idea of creating a healthy and robust marketplace for investors who want to both reap financial returns and create social and environmental impacts. And this area has been of great interest to us at CASE since we've been working with social entrepreneurs, and it turns out capital is really important to social entrepreneurs and their growth. We launched our CASE I3 speaker series last month with an amazing lecture from Anthony Bug-Levine, who is now the CEO of the Nonprofit Finance Fund, and that lecture is on our website at case@duke.org. And we're pleased tonight to present our second lecture from Ron D. Cordes, who is co-chairman of Genworth Financial Wealth Management and founder of Impact Assets. Ron is also a member of our CASE I3 advisory board, and he is quite a successful pioneer in the creation of financial markets. He helped create Asset Mark Investment Services and helped build the private wealth management industry through that company. Lately, he has turned his attention to solving the world's problems through social entrepreneurship and impact investing through new enterprise creation, through partnerships, and through his family foundation. I think you're going to see tonight that Ron is a true entrepreneur with passion and conviction, but he's also someone who sees financial markets as systems that need help at critical points. His experience across the nonprofit, business, and academic sectors involved with social change is vast, and his focus very strategic. I can't wait to see what he will share with us tonight about what he thinks the impact investing market needs to flourish and grow. So without further ado, here's Ron.
Thanks, Kathy. What a great high-tech room here. I came in and I just said, geez, could I get an easel? And they said, well, we don't have easels here, but we've got this auto magic thing on the thing where if you write on it, it'll show up on the screen. So, well, thanks for having me here tonight. I'm really happy to be here. What I wanted to do was to take a few minutes, give you a little bit of a perspective, share the journey that I've been on for now the better part of the last 5 years, moving from the for-profit world, a 30-year career in the investment and wealth management field, into first the world of social enterprise, then the world of impact investing, and really now looking at, as Kathy said, from a systems perspective, how we as a family foundation and some of the organizations that I've been involved in starting can really look at how we solve the big problems of the world and what I call it catalyzing capital for impact. And I'll talk about various forms of capital and kind of how I see that equation fitting together. So first off, just background so you kind of get where I come from. Graduated in 1981 from University of California, Berkeley, where I can tell you our classrooms were not nearly as high-tech and aren't still today. Went straight into the investment business. And two young partners and I of a firm in our late 20s began to look at ways to build out a financial planning firm in the San Francisco Bay Area. And we began to build systems and practices within our firm that eventually we determined could be marketed as a separate business to other financial advisors. So really what I've been in for 25 years is the infrastructure business. We built a wealth management firm that rather than having our own retail or direct clients, served financial advisors. Sold that firm called AssetMark to a Fortune 250 company called Genworth Financial in 2006. And today that business, which is the wealth management business of Genworth Financial, serves about 140,000 individual investors, 6,000 financial advisors, and has $24 billion of assets under management. So it became a fairly substantial firm. My story in social enterprise started in about 2004. I'd reached my 45th birthday, and I started looking forward. And I decided that when I was 50, I wanted to be on a different path than the path that I'd been on for the prior 25 years. And it wasn't for me about kind of changing jobs, because everything I had and everything we had financially was built into a company that my two partners and I had built for the prior 15 years. So it was about selling a company. Well, first it was about convincing my two partners to sell a company. But selling a company and then ultimately deciding what I wanted to do next. So we sold our firm in 2006. I signed a 3-year contract with Genworth to be the CEO of this combined business that we built. But in 2006, my wife and I did something we'd always wanted to do. We created a family foundation. And what I learned pretty quickly was the act of giving money away, particularly when you have a family foundation, you've got people that can actually do all that administrative stuff. The act of giving money away is relatively easy, but how do you give it away effectively? How do you give it away with leverage? And how do you punch above your weight, so to speak? We realized really quickly we weren't the Gates Foundation. We had several less zeros in our balance sheet. So no matter how passionate we were about an issue, we couldn't write a $10 million check to solve a big problem. I actually think, looking back, that that was incredibly liberating, because we had visions of how to solve big problems, but we didn't have the resources to do it in the conventional way, so we had to start looking more unconventionally. It was about that same time that a gentleman that we'd recruited on our foundation board, a good friend now named Jerry Hildebrand, called me up in early 2006. And he said, "I've just accepted a new assignment and I need your help. I've just accepted an assignment to come on board and create a Center for Social Entrepreneurship at a university in California called the University of the Pacific. And I'd really love your help." And I said, "You know what? I love you. I'm with you. We're 100% behind you. I just have one question. What exactly is social entrepreneurship?" I've been familiar a little bit with microfinance. Jerry and I had actually worked together in funding a microfinance fund, but I really wasn't familiar with the field or the movement of social entrepreneurship. So Jerry sent me a box full of materials, including Professor Dees and Jed Emerson and David Bornstein and some of the folks that had done great writing and thinking and research in the field. And what I started to realize is, as an entrepreneur, I was hardwired to be thinking like an entrepreneur and thinking like a social entrepreneur. So it just really made sense to me, this idea that it was possible to use business metrics to attack really important social, environmental problems. So we became early supporters of this center in California. We began to invite social entrepreneurs in from all over the world for talks like this. And as I met them and spent time with them, I realized that there were opportunities to do some amazing things. And again, getting back to the ability as a small foundation to punch above our weight, I realized that we had an opportunity to really be a player in this newly emerging field. At the same time, having done a little work in microfinance, I also became interested in, as a small foundation, how could we leverage our grants budget, which, like most foundations, we were giving away 5 to 6% of our corpus per year. And I kept looking over at the other 95% and saying, why can't we be as impactful with that other 95% as we are with the 5% that we're granting? And that started the journey into the field that at the time in 2008 hadn't even been named. Impact investing was a term that, interestingly, you brought in my friend Anthony Bug Levine for the last presentation. Impact investing was during a term that was named during a series of meetings that Rockefeller Foundation had in 2008, 2009, and 2010, which I happen to be involved in some of them. And the concept was, there's all kinds of people talking about this investing thing, and some are calling it social enterprise investing, or social impact investing, or impact investing. And if we're ever going to develop a field, we all have to commit to calling it the same thing. So I think life is about turning points. And for me, the real turning point, so from 2006 to 2009, we were starting, I was continuing to work full-time at Genworth. I was making a decision about when I really wanted to shift over kind of more into this side. And I took a group of people through the University of Pacific to Sub-Saharan Africa. It was my second trip there in 2008, Kenya, Rwanda, and Uganda. And part of that trip, we went to a rural village called Bayubo in Uganda, 6 hours off the beaten track. The last 45 minutes on what could really be described as a stream that doubled as a trail and a jeep to get to this little village where we'd been involved the year prior in funding a microfinance program. Started with 20 borrowers and was now up to 100 borrowers at the time. We got there, we were the first kind of outsiders from outside of their local community that had been in that village in a long time, so they greeted us. The women, it was run by a widows association in the village. Many of them had lost their husbands to the civil war that had been raging in Uganda for about 20 years in this northern section. And they were really excited, these women, to show us the businesses that they created through their microloans. So we spent an afternoon there going literally from business to business, selling chickens and eggs. Little woman that had created a little stop for people traveling through as a restaurant. A woman that sold used clothing. And when we got to that third stall, the woman that sold used clothing, it was clear to us that she had something really important that she wanted to share. And so in her local tribal language, she translated it through the woman who was leading the group. And what she said effectively was, we appreciate it when you, people from the Western world, come to Uganda to save our children. But we need to be able to save our own children. Thank you for investing in me so I can do that. Now that was a turning point for me because I started really thinking about how empowering it was for the relationship that had developed between she and I as an investor-investee as opposed to a grantor-grantee. And when I came back to the US, this was November of 2008, I made the decision that I wanted to see what I could do to provide that type of economic opportunity, not just for her and the other women in the Bayubo village, but for thousands or perhaps hundreds of thousands of others who were seeking that same opportunity to climb up the economic ladder. So it was then I made the decision to step down from my CEO role at Genworth, take on a more strategic role, so I work part-time now for the firm, and really start to devote time and effort and thought to how is it that a small family foundation can maybe take an outsized focus role in creating change in this conversion, this combination of social enterprise and impact investing. So I went to our board of the foundation, 2008, and I said, I think we should allocate, over the next 24 months, 20% of our portfolio to impact investments. I don't know how we're going to do it yet. I don't know where we're going to put it yet, but I think that we should set that goal that 24 months from now, 20% of our portfolio should be invested for impact. How hard could that be? Through the University of Pacific, which has an MBA program, I recruited a group of MBA students, and I said, I need you guys to create a landscape for me of what this impact investing field looks like. We now have a foundation. We're going to dedicate 20% of our portfolio to impact investments. So I want to know, what are the investment opportunities out there? Individual companies, what funds are out there, who's managing capital, debt, equity, geographies, local, global, go out and find them. About 2 weeks later, I got a call from this group. And they said, you know, there's really nothing out there. This is hard. And what I began to realize was, and I've been in the investing field for 30 years, so this is a new asset category. They can just go out, they can find some databases. They're students, they're resourceful, they have Google. What I realized was there was little, if any, of the traditional investment infrastructure. So the students continued to push forward. They were getting some academic credit for it, so they were pushing forward to try to figure it out. I helped them make some connections, and what we began to realize was that as an impact investor, one, it was a marvelously collegial space. So the best resource that we had was finding one impact investment firm and then asking them, who are your competitors? People who invest with you, who else do they invest with? And what we found was the folks were marvelously collaborative, and we began to build out a database of firms that we could consider investing with? Well, long story short, we're now 3.5 years later, in 2012, we're 31% invested for impact across debt and equity, early stage ventures, some later stage ventures, everything from, interestingly, a very unique, fully sustainable home foreclosure prevention program in the San Francisco Bay Area, in which we actually partner with Self-Help Ventures in California, to programs in South Africa involving free education for students in townships, to financing cooperative trade, fair trade cooperatives in the developing world. So we now run the entire gamut. But what I realized was, in stepping back, that for every investor like us that was willing to do the heavy lifting to get from 0 to whatever percentage, there were probably 100 investors that would have been stymied at some point along that way because it was just really hard. So what I started thinking about was, maybe there's a contribution that we could make as a family foundation in this whole area of infrastructure. And what was kind of the circle for me was, well, that's the business that we built, was infrastructure in the financial space through AssetMark and then Genworth. So I spent about 6 months starting to think about infrastructure more broadly. And when we finally put out our website in 2011 and kind of defined all the things that we're doing, it actually fit together under some broad categories that, again, I call catalyzing capital for impact. So if we start just in the center, see if this actually works. It does. So we start in the center. I just call that issues. So in the center of the pie for me is all of the big problems of the world. People, planet, social, environmental. All of the things that we collectively as a field are trying to address. And how are we addressing them? We're addressing them through social enterprise. We're addressing them through a variety of different enterprises and initiatives that are sustainable, scalable, replicable, measurable, and have the opportunity to be really bold and innovative. Now, we thought about what our role could be as a small family foundation, and we supported a number of social enterprises. But we thought, there's brilliant entrepreneurs in this space. We don't need to be another one of them. We don't need to create our own enterprise. What we really need to do is see if we can't create some better infrastructure that supports what's there. And what we felt was really needed in the direction that we've gone is about creating what I call a circle of capital around these social enterprises. So on the left, you've got human capital, and on the right, you've got investment capital. So starting with investment capital, and again, looking at how hard it is, or was for us, to get from 0 to 30%, I looked at it from kind of a big picture societal perspective. Most social enterprises have a very difficult time raising traditional investment capital. So where do they find their sources of capital? They find it in philanthropy. They find it in the $300 billion a year that we as Americans, individuals, foundations, corporations, collectively give away. That's a great number. That's a big number. But it's entirely dwarfed by the $37 trillion that we as Americans have collectively in investment accounts. So I kind of looked at it as a big pocket and a little pocket. Here we've got the world of social enterprise that's really trying to be funded by this small pocket, if you will, of philanthropy. And what if we could catalyze even 1% of that big pocket? 1% of 37 trillion is $370 billion. That would more than double the amount of money going in through philanthropy. What's keeping that from happening? So we partnered with some folks, the Calvert Foundation, who Lisa Hall, I understand their CEO, who's a great friend, is going to be coming to speak in a couple of weeks. And the Rockefeller Foundation, where your last speaker, you're right in the middle of things here, Kathy, where your last speaker, Anthony Bug Levine, was leading their impact investing initiative. And we partnered with them on a study that said, first off, I looked at this kind of empirically and I said, okay, I've been in the investment business for 30 years. think there's this great opportunity to try to catalyze capital, but really want to figure out two things. If there's $37 trillion of investor capital out there, then one, are investors interested? Is there actually demand for impact investing? And then two, if there is demand, why isn't anybody doing it? Why isn't any of that demand being catalyzed? So there's a study that's actually available. It's on the GIN, the Global Impact Investing Network website. It was done by a firm called Hope Consulting out of San Francisco. And they did a survey of 4,000 affluent and high net worth investors and asked them a whole series of questions to try to determine if they had an opportunity to invest in an impact investment, which they defined as meeting a social or environmental objective and having a financial return, would that be something that they would be interested in? Well, 48%, nearly half, said they'd be interested or very interested in making that type of investment. Then they asked, how many of you are actually doing it today? That number was so low it was almost unquantifiable. It was a fraction of 1%. And I'm actually convinced it was pretty doggone close to zero, because when I looked at some of the background data, some of the things that people thought were impact investing and answering yes were actually really more just kind of venture philanthropy contributions. So what a big chasm. 48% said we're interested in impact investing, but virtually zero said they were doing anything. What I found really interesting was then digging down to the next question: why aren't you doing anything? And the answer came back, a number of reasons, but 51%, the highest response was, I rely on one or more financial advisors for anything having to do with my investment portfolio, and my financial advisor has never engaged me in a conversation about impact investing. So there kind of a light bulb went off for me. I've spent 25 years working with financial advisors, still have an opportunity today to work with 6,000 of them at Genworth. And here it is that I'm coming into this new space. I've stepped back from my role at Genworth. I'm trying to figure out how can we as a foundation play in this space. And here's what investors are telling me. Well, the problem is financial advisors, this industry that I've been involved with. So as Kathy mentioned, I'm now partners with the Calvert Foundation and the Rockefeller Foundation and some others in a new venture called Impact Assets. ImpactAssets.org. And what Impact Assets is, well, first of all, it's an oxymoron to all my friends in the investment business, because it's a nonprofit financial services company. Now, that's easy for us to understand, but there's folks on Wall Street that scratch, wait a minute, nonprofit financial services company. What we are is an entity that's designed to be a sustainable social enterprise. We actually raise the closest you can raise as a nonprofit to equity capital, some participating notes, the repayment of which is based on our financial success. And we did it to do a couple of things. One is to build the field of impact investing, and two is to become the go-to resource to engage financial advisors in connecting their clients with impact investing opportunities. So if I look at what we do as a foundation, Impact Assets is over here on the investment capital side. Our goal is, over the next 5 years, to be responsible on our own for catalyzing $1+ billion of capital. And more importantly, as a nonprofit field builder, to catalyze 10 times that amount, because we're hoping other people will follow us, copy us. So when I built my firm, AssetMark, it's interesting. As I think about this now, my partners and I built AssetMark with one goal, maniacally focused. We wanted to be the very best firm in the world at what we did. And we not only wanted to beat our competitors, you know, it was a zero-sum focus game. If we lost market share, somebody else won market share. It was all about beating the competitors. Now in what I'm doing, I'm looking at it a little different way. And rather than wanting to be the best in the world, we want to be the best for the world. One small change, we're still maniacally focused on how do we become the best at what we do, but at AssetMark, if Merrill Lynch copied what we did and raised twice as much money as we did, we'd be trying to figure out, I wonder if we can sue them for IP infringement. At Impact Assets, if Merrill Lynch copies what we do and catalyzes twice as much capital as we do, it's a win. Because what's important for us is being sustainable, which we can be on our own, but it's being a catalyst for great things happening in the world. So we're actually working now in partnership with firms that may or may not end up deriving us financial benefit, but that are driving scale and catalyzing the industry. So we've done a couple of things at Impact Assets that we're proud of. One of them is we developed the first database, published database of impact investment managers called the Impact Assets 50. And it's available on our website. And it's 50 managers selected by an independent panel that we created, led by a fellow who's now part of our team named Jed Emerson, who many of you have heard of, who's been co-wrote the book with Anthony Bug Levine on impact investing, been a leader in the space for about 20 years. And Impact Assets 50 was really based on that frustration that I mentioned 3 years ago, which was, where do you go as an impact investor? Or where do you go as a financial advisor who's interested in actually investing client dollars? You need to see the universe. You need to see who's available. So we had about 400 submissions from firms. It was interesting. We launched this at the Clinton Global Initiative, got a bunch of fanfare and media, and we had all kinds of firms sending stuff in. We had firms trying to position themselves as impact investment firms that I'm not even sure could spell impact. And so one of the things we had to define right up front is, what is impact investing? What does it mean? And what are we looking for in an investment firm to tell us that they're actually looking for the impact? And Jed Emerson has led this, and he calls it firm impact capacity. The idea is that I sat in on Kathy Clark's class earlier this afternoon, and the whole concept of metrics. The metrics business in impact investing is still at a very early stage. There's some really cool stuff happening. I think you're going to talk to the B-Lab folks, the Gears Initiative, a bunch of great acronyms, a bunch of great things going on, but it's still at a very early stage. So to actually go to an investment firm and say, show us the measurable impact that you've had in your portfolio over the last 5 years, from start to finish with a double-blind study, okay, you're going to get zero. Nobody's there. So instead what we've done is gone to the firms and said, we want to understand your thesis of change. How is it that your firm is structured? What is it that you're intending to do with the capital? So show us that you have a thesis of change, and B, a way of measuring that change. And we recognize that you may not have been in business long enough to have a full cycle measurement, but we certainly want to understand that you're doing this intentionally, as opposed to impact being created by just some accident of where you might be investing, and two, that you're committed to measuring that impact. So we whittled down the 400 firms to a list of 50. Those 50 firms manage $8.6 billion in total. Now that may seem like a large number, but the average firm is about 170 billion or 170 million, whatever that number works out to be. So these are a bunch of small firms who are all trying to build to scale. And what we're trying to do is, by positioning them together, provide a database that will allow a financial advisor or an interested investor to go in and look. If they're interested in microfinance globally, they can see who the top 5 firms are. And what the wealth management industry was telling us is, if we know who the players are, we can figure out which one we'd like to invest with. We just have no way of figuring out who they are. So Impact Assets 50 was the first thing we did as a field building initiative. Then we launched a donor advised fund designed to allow people to use that charitable vehicle to invest for impact. We've got about 80 million in there today. And now we're launching a series of registered products, debt products. The first 2 will be microfinance and global sustainable agriculture, which will allow financial advisors for the first time to put clients in impact products with multiple managers with a $25,000 minimum investment. One of the big issues that we found with the impact space is that in the arcane way the US securities laws work, most investments were limited to people with 5 million or more of capital and took at least a $500,000 minimum investment. So if you're the Gates Foundation, that could work, and they've actually been very active impact investors. But if you're an investor with a $1 million portfolio, your appetite for impact, even if you're one of that 48% that's really interested, might be 3 to 5% of your portfolio. And 3 to 5% of your portfolio is a whole lot less than $500,000. So what we're trying to do is democratize impact investing, bring it down to a level, make it simple enough that we can bring it out through the financial advisor community Our goal is that 5 years from now, first of all, 5 years from now, when all of you, of course, will have financial advisors because of the success you will have achieved based on your MBAs that you've received here, you'll be able to go to your financial advisors or look within your 401k program options and find impact investments. Be they global opportunities like microfinance, bringing clean energy to the developing world, global sustainable agriculture, charter schools here in the US. We've got about 10 different thematic issue areas that we're interested in. The first 2 are coming out in the spring, and we're looking to put more out from there. So that's kind of what I'm doing on the catalyzing capital side. But what I realized at the same time was you've got to have this circle of capital. You've got to have both human capital and investment capital invested in these social enterprises for this movement to move forward. And what's interesting is I got started in this on the human capital side because, as I mentioned, we funded a program very similar to the CASE program at the University of the Pacific in California. And one of the things I realized that I really hadn't fully appreciated before was the amazing social consciousness of this generation, the next gens, the Gen Y, millennials. Our program at Pacific is primarily focused on undergraduates. But we get kids at 18 that come on our campus, 900 a year. They want to change the world. And I get the opportunity to address all of them at the beginning of the year. And what I typically tell them is, you're here because you want to change the world. We want to equip you and connect you to do that. You're naive enough to actually believe that you can make it happen, which means that you've got a very high probability of success. So we've decided to support a number of initiatives around the country through a group called Ashoka, which many of you may be familiar with. Ashoka was started about 25 years ago by a gentleman named Bill Drayton, a McKinsey consultant, who was really one of the godfathers of the whole social enterprise field, along with Professor Dees and several others. And Bill Drayton's idea was, let's celebrate social entrepreneurs that are doing amazing work by creating a fellowship called the Ashoka Fellowship, and then creating a community for those fellows so they can all share best practices on a global basis. So Ashoka created a program about 3 years ago called Ashoka U, which was doing the same type of thing, celebrating what universities were doing around teaching social entrepreneurship, and then creating a community for those universities. So many of you are probably aware, the first of the what's called the Ashoka U exchanges was held in 2009 in DC. The second was held right here in 2010. And the third will be held in 2 weeks at Arizona State University in Phoenix. Last year, I think we had about 70 campuses represented, about 350, 400 people. This year, we've got 100 campuses represented and about 500 attendees. And one of the things that we do now combined with Ashoka is we provide an annual series of innovation awards. So this year, we're recognizing 6 universities who are doing something innovative in social entrepreneurship education, either on the curriculum side or the experimental, the experiential side, or some combination of both. So the idea is, how do you promote the best and the brightest students at our universities becoming aware of social enterprise as a movement, becoming aware of opportunities in the field, and then getting connected with curriculum and experiential programs that really allow them to move that interest forward. So that's one project on the human capital side. There's 2 others that we've done. We were involved in founding and now run an international conference called the Opportunity Collaboration. This is a conference, 5-day conference in Mexico. It's run around World Poverty Day each year. We're in our we've just completed our 3rd year, so we're now in our 4th year. And it was based on a simple concept. What if you took everything that didn't work about every other conference in the space and you eliminated it? No PowerPoints, no speakers, no plenary presentations, no neckties. It's done at a resort. We rent out an entire resort in Ixtapa, Mexico, and we have a simple concept. We bring in 350 invite-only of the very best people in the space from around the world, and we give them an opportunity to develop the entire curriculum and to use it all as a discussion group format. Because those of us that have been to the World Economic Forum, or the Clinton Global Initiative, or the Global Philanthropy Forum, or the entire gamut, there's a bunch of really great conferences, But what happens is, in between racing to see Demi Moore and then heading over to see Tony Blair and seeing all the big names that are there, you get about 3 minutes of hallway conversation with the fellow attendees. And you end up walking away with a huge stack of business cards thinking, boy, it would have been cool to get to know some of these people. And then you take that stack of business cards, you slip it under your desk, and you go on another year. So we created this conference where the idea was, what if the whole conference was hallway time? What if you had 5 days in a resort location where you rented the entire resort and you gave the delegates an opportunity to develop their own discussion group curriculum for those 5 days? I'm dating myself here, but I dubbed it originally Gilligan's Island for poverty reduction. It's been a phenomenal success. And it's been a phenomenal success because the magic is if you bring the right people together, you don't need all the other stuff because they create the agenda. So we base it entirely on the outcomes that are created. And again, we look at that on the human capital side as an opportunity to connect people and to build the infrastructure of human capital that's needed for foundations to partner with other organizations, for foundations to partner with each other. We've had cases where, with 28 countries represented last year, we had 2 social entrepreneurs, both of whom worked in the same slum of Kibera, which is a huge slum, the largest in the world, in Nairobi, Kenya. Now, granted, it's 1 million people, but they were both running youth development programs in the same slum in Kenya. And you know where they met? Ixtapa, Mexico. Now they're working together. They're actually combining their 2 organizations, but that's the fragmentation that still exists in the social enterprise space. The other thing that we did with the collaboration is we created a program called the Cordis Fellows, where we gave scholarships to 50 young social entrepreneurs, generally under the age of 30, who otherwise wouldn't have been able to have financially afforded being at the conference. And my joke, we did it the second year. We announced that it was a diabolical plot to reduce the average age and increase the average IQ of the attendees. And what we got was some of the brightest, smartest, most passionate young people, 22 countries around the world. And again, the idea was to give that human capital a chance to develop and give them a chance to develop partnerships that they never would have. So that's the human capital side with one exception. That's the latest project that we're working on. And that is kind of a new vision that we're involved with, the Encore Generation. Now, most of you guys are a long way from being there, but trust me, time passes quickly. So, as I said, when I turned 50, I moved most of my energy into this direction. And what I began to realize is there's 76 million baby boomers today. They're turning 55 and 60 and 65 and 70 at rapidly increasing numbers. And many of them are seeking meaning and purpose and significance and looking at this new concept of an encore career, a second act, if you will. And so we looked at that in the foundation and said, again, going over to this side, human capital, what an amazing, talented, experienced reservoir of human capital that has of yet been untapped. And so we stepped back and said, how could we, again, be a player in that? So we partnered with an organization called Civic Ventures. Encore.org is their website. And they do something interesting each year called the Purpose Prize, which is an award given to 5 people each year over the age of 60 who are doing something significant for society in their encore career. So they began to do some research about, done a significant amount of research now about this baby boomer generation and how many would be interested. Just like we did on the impact investing side, what percentage of this baby boomer generation is interested in the opportunity to do something significant and purposeful from a societal perspective? And what they got was off the charts as far as interest. So then they began to drill down in the same way that we did in impact investing. How many of you are doing it today? And what we found was that very few were. Why the disconnect? Interestingly, it was uncanny. The disconnect was lack of a guide. There's nobody to really, I think it could be interesting, but where do I go? The problems of the world are so huge. I don't really have anybody that I can go to help me navigate through this and figure out where it is that I may be able to connect with opportunities. And what we began to realize is that a primary source, who is it that they talk to about retirement? Who is it that they talk to about their future life? It's their financial advisor. And as I began to look at that, it just made sense that we needed to be a player. Because as we're working with financial advisors to connect what I call clients' passions with their portfolios and connect their values with their investment portfolios, I realized that advisors were in a perfect position to begin to have a conversation with their clients about how to apply other resources, their human capital, their bandwidth, to the social sector as well. So we're actually calling it the new retire mentality. And it's all based on one concept. The concept is that for 25 years, and I've been as guilty of this as anybody, for 25 years the financial advisory business has worked with clients on one concept, and it's called the number. And the number is, regardless of what age you are now, you tell me what age you want to retire, move to Florida, live a life of leisure, and I'll tell you how big your portfolio needs to be in order to support that lifestyle. And we've been entirely focused on the number. What we haven't been focused on is the actual result of, is that really what people want to do? And be careful what they wish for. So as we're in an environment now where people are looking for purpose and meaning, what we're looking to do is to try to redefine what the term work means. Because I've become convinced through the research that we've done that the average baby boomer isn't looking to stop being purposeful and getting recognition and achievement. Many of the things that they receive out of work, they may be looking to get off the treadmill that they're on now. So we've redefined work as the following: that which delivers value to others and meaning to you. And we're starting to work with financial advisors around the concept that when you sit down with your client and you share the idea of how long do you want to stay, how long do you want to remain working? And the client says, geez, I want to stop working at 62. Okay, if we define work as I work 90 hours a week in the investment banking field, I never see my kids or grandkids, and I come home at 11 o'clock at night, I can see why you might want to stop that at the age of 62. If we define work as something that gives value to others and meaning to you, what people are telling us is they don't know that they'd ever want to stop working. So how do you begin to build that paradigm around creating the environment and creating the opportunities for people to engage in the social sector and deliver that human capital? And what I think is really interesting, and we haven't seen it happen yet, but it will, is the convergence between the two generations. The convergence between the passion, the enthusiasm, the energy of your generation and the experience and the gray hair of the baby boomer generation. How do we put that together? Maybe it's venture funder, CEO. Maybe it's advisor, board member, chief technology officer. Maybe it's somebody coming in as a chief marketing officer who did that for 30 years in their professional career and got pretty good at it and is looking now to do it on a part-time basis for a social enterprise. We see a whole variety of ways of taking that human capital, combining it with investment capital, and building an infrastructure for social enterprise. So that's kind of what I've been involved with for the last 5 years. It's been a lot of fun. It's been, I think, the most meaningful thing that I've ever done. And what's been really fun is being at the kind of the embryonic stage. Somebody asked me at a conference a couple of weeks ago, so impact investing. If impact investing were a baseball game, what inning would we be in? Well, that's kind of an interesting question. I thought about it for a minute. I said, if impact investing were a baseball game, the ballpark will have opened, they would have started selling snacks, and they'd be coming out for batting practice. That's how early we are. Now, it's frustrating for those of you that are going out and looking in May of 2012 and wanting to get jobs in the impact investing field. Unfortunately, I can tell you that none of the 50 managers on the Impact Assets 50 have a 2012 MBA class coming in. They're just not large enough yet. But I think the key term is yet, because we're in a space that is growing rapidly, we're in a space that's evolving quickly, and we're in a space that I think is going to be really exciting to become a part of, because it will become part of the lexicon of investing. I'm thoroughly convinced that 5 years from now, the concept of impact investing will not be something at the fringes. It'll be something that more than 48% of people will be interested in, and close to 48% of people are going to be doing something about, because products and services will be available. And what I'm particularly excited about is the capital and the leverage, again, out of that big pocket that we can put towards solving some of our big problems. So with that, I think we've got a little time for Q&A. Let's move to that direction.
Let's do that. So, see, or you want to stand? How do you want to?
How would you like to do it?
It doesn't matter to me.
Let's do over. You said.
Yeah. So I wanted to start with one question, then I do want to open it up to the audience. There's been a lot of interest in the leverage point of financial advisors over time in this space, before it was called impact investing, right, where people have become interested in corporate social responsibility and sustainability, and it seems as if there was a lot of resistance on the part of some of those advisors to even learning about new ways of thinking about portfolio management and how to represent these interests. Has there been resistance to impact investing concepts in the same way, or do you think this is changing?
So the answer is yes and yes. I think that financial advisors, particularly in the markets that we've seen over the last 4 or 5 years, have been resistant to adding something else on their plate that's new and that they have to become credible at in order to present it to clients. So I think the resistance has come from a couple of things. One, the markets have been difficult. Two is that there aren't great tools available. So if I'm a financial advisor, until we brought some things out with impact assets, if I'm a financial advisor and I really want to get good at impact investing, it's a struggle to try to cobble together all the things that I would need to find to feel like I'm credible at it. So we're hoping to make that process easier, but I actually think it's interesting. So 24 years ago, the financial advice industry moved from primarily being based on commissions and transactions to being based on asset management fees. And it was a huge movement in the industry. It took about a decade. And the entirety of our success at AssetMark, and I think the entirety of success in life, was we managed by just dumb luck to position ourselves in front of that wave. And as the industry moved, we ended up having products that were moving from commissions to fees. Now the corollary here is that for the first 5 years of offering those products, we offered them based on the idea that this is great for clients. Clients want to move from commissions to fees. This is a great way for you to get on the same side of the table. And advisors resisted. Why? Because it was new, because they didn't feel like yet they'd been properly trained and equipped on how to present it, and because they were concerned that it wasn't going to end up being great for their business. Well, 5 years into it, we repositioned and we said, you know what, this is in your enlightened self-interest to do, and here's the reasons why, and here's some success stories of advisors that have moved this direction. So not only is it good for your clients, but it's actually really good for your business, and it's an opportunity to build a much more robust, successful business. Made all the difference for us then, and that's the way we're starting now to position it at Impact Assets, is impact investing has great benefits, obviously, for society, has great benefits for your relationship with a client, but you have an opportunity to be an early adopter. And you have an opportunity actually to do something productive and beneficial for your financial advisory practice by taking the time and effort and becoming good at this new field. And we're seeing resonance there. We're seeing that advisors understand that this is the way the industry's moving, and the early adopters are starting to move. But it takes time.
Yeah, and it will. David.
Ron, thank you for tonight's talk. It's very encouraging and exciting. I have one question that goes back, I guess, to the beginning when you were talking about how 31% of your family's foundation is in impact investments. So I guess I have two questions that are related to that. Are those market rate impact investments, which is the first question, and then the second question somewhat related to that is, many of the impact investment infrastructure is a fund structure, so a longer life or a debt structure, not a liquid trading instrument. So you talked about smaller size, you need 25,000 or smaller size for individuals and financial advisors to convince people to invest their money in impact investments, but you would also need liquidity.
Yeah.
So there's a few people working on a liquid retail product, but what are your thoughts on the fact that you actually need a liquid product as opposed to a fund, because you kind of need the luxury to invest in venture capital private equity structures as opposed
And let
to
me summarize that briefly since we are taping. It was two questions. One is from your foundation, are those market rate investments, the 30%? And the second question was about liquidity instruments in particular and what the needs are to have more liquid types of investments.
Absolutely. So let me answer a couple of different ways. First of all, I define impact investing as an investment that delivers a financial return. And that financial return can be anything from above zero to a full market return. So I would say that in our portfolio, we've got a combination of investments where we expect to earn a full market return on whatever emerging market debt or equity. And we have investments where we are consciously expecting to earn something less than a market return. And we really look at toggling the social and the financial return. So I'll give you an example. We do a lot of investing in microfinance. So if I'm going to make a microfinance investment in Peru, let's say, I'm going to look to earn a market return because that's a very robust, developed microfinance field, and there are great opportunities there to grow and scale existing organizations because the infrastructure is built. If I'm going to invest in and I do invest there and earn market returns. If I'm going to invest in microfinance in Zimbabwe, which I do, I can't expect to earn a market return. I'm willing to be an early pioneer in helping build that market and earn less than a market return because I'm feeling that there's an outsized social benefit that can come if I'm part of the capital that catalyzes the market. So I tend to be agnostic about market versus below market. There are some that say impact investing should only be market return, and there are actually some that say impact investing should only be below market return. And I think it really depends upon the issue area, how robust the field is that you're in, and I found success both ways. Just a quick story on track record, because people ask about what's the track record. Well, we started investing in end of 2007, early 2008. Now, how many of you were in the investment field before you came to Fuqua? So, anybody that wasn't, 2008 was not a good year. So, Bear Stearns, Lehman Brothers, AIG, average market investment on the equity side was down 30+% in 2008. And the balance of our portfolio was certainly not immune to that. Single best investment in our portfolio in 2008 was microfinance debt. Completely uncorrelated to all the rest of the financial markets. What we realized was, so think about this. In 2007, we had a couple of different things in our portfolio. We had a bunch of microfinance debt from banks in countries whose names I couldn't pronounce, nor could I find them on the map. And then we had investments in JP Morgan, Bank of America, et cetera, et cetera. The blue chip companies in the financial space. Well, by the end of 2008, the microfinance investments had trumped anything else we had in our portfolio. Now, they were debt, so it was easy to understand where it was that we were from a liquidity, et cetera. So I have a lot of equity investments today in social enterprises and funds, and people ask me, geez, how are those equity funds doing? I say, ask me in 2018, right? Because we made the investment in 2008, 2009. I like the progress, but it's going to take a while. So circling back, as we put our first products together at Impact Assets, we recognized that we couldn't ask, what we're asking impact investors to do, financial advisors and individual clients, is to put a toe in the water. Get that first toe in the water and realize once you got it in there for a little bit, it's not going to get bit off by a shark, so maybe you're willing to go in a little bit further. We realized that as much as I love early stage social enterprise equity and have it in my own portfolio, we can't ask investors to put a toe in the water, leave it in there for 9, 10, 11 years, and then hope they get back a return. So the early products are debt products, microfinance, sustainable agriculture, with reasonable liquidity. You lock your money up for 18 to 24 months. It's well diversified. You've got a coupon return of 3.5% to 5%, which in today's market, I would argue is a full market rate of return. And you've got the opportunity to actually have a line of sight on when you could get it back out. So our feeling is that that's the first step. And then as investors get comfortable with those types of investments, we can go up the risk spectrum a bit and begin adding equities. But I think it's going to take a little while because investors are going to need to see a quarter, 2 quarters, 4 quarters, a year and a half, 2 years of returns before they really appreciate that these are real investments and it is actually possible to have that double bottom line.
Great. Ben?
I'm Ben Bingham. I'm not a student here. I run a company called Three Sisters Sustainable Management. And I actually was trained with Genworth at Legg Mason in the maybe 2002. We used your manual, so I appreciate it and all you're doing. I'm also interested in the whole scaling question, and I think two other areas that I think are really important. I'd love to hear what you think about them. Are the gatekeepers at the foundations and the other institutions, the pension funds. There's a whole network of consultants who don't know anything about what you're talking about, that really are needed to scale this on a much bigger scale. And the other area is due diligence. It seems to me there needs to be a whole infrastructure of due diligence teams creating and developing and finding all the things that need to be done that you call issues, and what are the issues that actually could create opportunities for a return that would pay for a pension. And I believe
So let me try to summarize that question very quickly, which was, what about some of the other gatekeepers in the marketplace, particularly around foundations and pension funds, where there are consultants and not necessarily wealth advisors who are offering that advice and or obstacle? And then the second question was about due diligence and trying to improve the process in which we decide what is investable and how.
Yep. No, great questions. And so one would think, well, let's start with a misconception that I was disabused of very quickly. So one would think that $600 billion today of philanthropic assets are in charitable foundations, led by the largest foundations, Gates and down on the top 100. One would think that that would be the low-hanging fruit for impact investing, and that they would be the leaders in taking a portion of their investment portfolios and investing them in accordance with whatever the parameters are and the goals and issues, in Gates's case, global health, for example, on the grant side. Was not the case. And interestingly enough, the exception to that rule is, in fact, the Gates Foundation. So my friend Alex Friedman, who's now at UBS, was for a number of years the CFO at the Gates Foundation. He convinced Bill, Melinda Gates and Warren Buffett to take 1% of their liquid assets and invest them for impact. Now, it may not sound like a whole lot of money, but they have a lot of zeros on their balance sheet. So 1% of, at the time, which was $40 billion of liquid assets, was $400 million. And they did it for two purposes. One was because they believed in impact investing, and two was because they felt, as a demonstration project, if they could actually show that the biggest, most behemoth, most bureaucratic foundation in the world could put 1% to impact investing, then they could inspire the other 99 of the top 100 to follow them. And they went to the point of completely open sourcing everything from the legal documentation, their due diligence, the way in which they work with their board and their investment team, and they actually ended up deploying $400 million. And some great case studies came out of that. Credit enhancements to finance a KIP, the Knowledge is Power program, the KIP Charter School Bond program, a great investment with Root Capital in Boston, which provides co-op financing for fair trade co-ops, a bunch of different things across the spectrum. And those investments have been largely successful financially. One problem is they had very little throughput in convincing other foundations. So what I began to realize is the money is there, and it's interesting. And I speak to a lot of foundations now, and what I get from them is, yeah, but we've got a fiduciary responsibility. And that word fiduciary responsibility, it's a word that you're taught early on as an investment advisor. Whenever you don't want to do something, you just say, we have a fiduciary responsibility. And because nobody really understands what fiduciary responsibility is, oh, okay, sorry, can't do that. So they say, we have a fiduciary responsibility that these investments, this theme is still too new, so we can't invest in it until it's been more proven. I've actually made the argument that I think that charitable foundations have a fiduciary responsibility to do impact investing. And that if you're not catalyzing the balance sheet that you've been provided because you've gotten a tax deduction for putting these dollars in, then you're not following your fiduciary responsibility. Now, in our foundation, what's really interesting is the fiduciary responsibility is between the board and the trustees and the investment team. So it largely is what you want it to be. So we've defined that in our foundation, 31% is invested for impact, and for that 31%, we're looking at both financial return and in our case, social return, because it's mostly economic empowerment, and that's the way we're measuring it. So there's no disconnect as a fiduciary. If our investments don't perform as well financially, we're looking at, on the below market investments, did the social return make up for that? So I've been disappointed that the foundations, the pension plans, those that use the traditional investment consultants have not come aboard as quickly as I would like them to, because they are the big pools of money. I'm convinced they will come aboard, but I'm actually convinced today the lowest hanging fruit is family foundations like ours, founder-driven, where you don't have a huge board or an investment committee to get from the point of being interested in investment to actually implementing it. That said, I'm involved. We made an equity investment in one manager called Microvest Capital. It's the manager that actually provided that return for us in 2008 in the microfinance market. And we made an equity investment in them as a foundation because we really believe that they can be one of the leaders in the space. And they are now taking some products with 5+ year track records out to the institutional community. And they're banging up against doors, but they actually have products that have an institutional track record, and I believe they'll be able to get those products through, and it just simply takes, it's a process. So again, I think it's coming, but I see individual investors actually as being as disjointed as they are to catalyze through financial advisors. I actually see that decision-making process as being more direct today than some of the large institutions. To your second question on due diligence, we've actually found that financial advisors have been totally comfortable, so the wealth management firms have been comfortable doing due diligence on investment funds for impact. They've been completely comfortable from the financial side. They say, we evaluate managers for a living. So people, process, performance, track record, how the organization is structured, the thesis that they're using from an investment perspective. Many of them say, we have a lot of emerging market private equity funds today, so we're comfortable with these geographies. We know how to look at it. What they don't know how to look at is the impact side. And that's where we've tried to publish, and Jed Emerson has been very involved in this, trying to publish some white papers to help financial advisors say, how do you evaluate the firm's impact capacity? Because again, many of them don't have metrics and track records. So how do you evaluate, and it was so interesting to sit in your class today and look at things like a thesis of change, right? How do you evaluate whether that makes sense and whether the firm is thoughtful and deliberate and thorough in putting that together? And then it's not so much about a thesis of change and what are those double-blind metrics that have been proven empirically over 5 or 10 years. That will come. Today, I think it's about a thesis of change. Are you committed to measuring it? What does that measurement process look like? And are you going to be transparent, positively or negatively, about that measurement process moving forward? And Kathy mentioned it in her class, the whole kind of thing in CSR, where if you come up with one metric and 2 years later you find that metric isn't looking positive, you pivot over to another one. Well, what we're looking at in the impact field, and it's why we're a partner with the GEARS initiative, is come up with a metric, commit to the metric, measure the metric, and be committed to live with those measurements. And so that's, I think, we're in the middle of that journey today. And it's another reason why institutional investors, I think, will be a little later coming aboard, because they'll want to see a little bit more of that happening. But I will say, I've seen Europe's ahead of us, which is really an interesting thing to say in the world in which it is today. Because Europe is so maligned today, right, for the European banks and Greece and Italy and everything going over there. Europe is way ahead of us institutionally on an impact investing side. Whether it's sovereign wealth funds, whether it's banks, whether it's private wealth groups, whether it's pension plans, most of the institutional money in this space today, whether it's US funds or European funds, has been invested from European investors. So we need to look at what they're doing in Europe. They figured out the fiduciary thing over there, and we haven't yet figured it out here. So we're working with a number of consulting firms in the US to say, why is it that your affiliate in Amsterdam or London or Geneva has X% of impact investing on the books, and you guys haven't done it yet here in the US? And so we're starting to, there's starting to be movement there, but it's a slow process, and it's one that I think is going to be fairly deliberate.
Let's take one last question. Yes. Yeah.
Bob Shull, I work at Self-Help, and I've been spending 20 years trying to connect the investment capital with social entrepreneurs at Self-Help. I think we're probably using the baseball analogy in the first or second inning, because I've there's been many of us been doing it for 20 to 30 years.
Yeah, batting practice lasted about 9 hours, probably.
Yeah, okay. But I wanted to talk to you about the same issue that we've been talking about. In my experience, I find that most social investors have great interest in it, but they have no ability to assess risk. They want liquidity, and they want a market rate. And so, as an intermediary in this field, trying to please them and get the money to the social entrepreneurs, we've tried to meet those goals, and we've done it two different ways. We have a financial institution that has depository insurance, credit union with insurance, so those folks can get a federal insurance on their deposits, so they're happy about that. And they can get liquidity if they put in the right type of deposit. But for larger, but that cuts off at 250,000. They won't play with us after 250,000. But so for and we need to be able to attract investments of 10, 20, 30 million. So in order to do that, we need to get to the institution or the large kind of wealthier individuals. And they again have this problem. They want liquidity, they want market rate, and they want to know it's safe, and they don't have an ability to do that. So everybody's been told us what you need to do is get credit ratings. So we actually went and we securitized some of our assets, we got them good rated, and we sold them on the market. And we realized we don't need social investors anymore. Once you do that, it looks just like any other investment. And quite frankly, social investors are harder to deal with because, they're harder to find. They want metrics. We have 30 years of metrics, but they want a different kind of metric than the kind of metric we've had. I can sell it in the market, and they'll buy it like anybody else will buy a good piece of paper. So there's no advantage to social investors. So there's this irony that you go to the trouble of, you meet the demands of the social investors, or the impact investors, and at that point they become irrelevant. Have you found anything?
How do I summarize that? Do you want me to? So from self-help here, the perspective is, it seems as if impact investors want low-risk products.
They want products that have a risk rating.
A risk rating to them. Liquidity and market rate, and in their process of trying to develop safe products above the FDIC limitation, they went and got their products credit rated, and now are wondering whether they need impact investors at all.
So a couple of really interesting things. First of all, risk. So it was kind of interesting. We were involved in this study with Rockefeller and Calvert and others that looked at impact investors, and they thought they had some groundbreaking information. I love the 48%. I love the thing about financial advising. They said, we figured out what clients want. We asked them what they wanted from investments, and they came back. And they said, we want something that's risk-free, that's entirely liquid, that delivers a full market return, preferably something in the 8 to 10% per year range. I said, well, geez, I'd love that too, but that just simply isn't available in the world, impact or not. So what's interesting to me, I think there's three themes. One is risk. So risk has a whole variety of different definitions in the investment world. But I think that for many people, what is unfamiliar is inherently risky, and what is familiar is inherently less risky. And so that's been to the detriment of things like microfinance. If I go back to 2008, 2007 in my portfolio, I'm going to pick on Professor Bewley, JP Morgan. I own JP Morgan, I own Bank of America, and I own Citigroup. And then I own all these microfinance institutions in all the stand countries in Eastern Europe and Latin America, et cetera. Well, anybody looking at that portfolio, whether they had any investment experience or not, would have automatically said, these investments are familiar, these investments are unfamiliar, so what is unfamiliar is inherently more risky. And I think what we've been through over the last 4 years has turned that equation around. So what we're trying to do is frame risk in terms of things other than familiarity, which is difficult. Second, I'm invested in an impact fund that invests in private equity funds in the developing world and that is seeking a full market return and has some early evidence over the first 3 years that it's going to achieve it. They had the same issue that you had in marketing, where they marketed themselves as an impact fund, and they found that investors were shying away from it because they didn't understand the impact world. And finally, one day, the fund CEO calls me up and he says, I'll never forget, he's a Canadian guy, so he says, impact schmimpact. He goes, I'm going to market this fund as an emerging markets private equity opportunity to take advantage of the fastest growing companies in the fastest growing developing markets in the world, and to provide an opportunity for investors to be in a new geography and a new asset class. They raised $85 million. Now they're still good, they're still committed to producing impact, but it's interesting to me. Now that they happen to have the benefit of having a full market return, but it's just interesting to me the dynamics. I'm still convinced that there is a market of people, and it's evidenced by the studies that we've done, that are looking to, again, combine portfolios and passions, that want to include as a piece of their portfolio investments that deliver a social or environmental impact. I'm convinced that with the right education and tools, that they're going to be willing to do that at somewhere perhaps even less than what a full market return would be. We're starting off on the debt side for a couple of reasons. One, because it's the only place you can provide liquidity. It's the only place you can provide some predictability of returns. You don't have to wait 10 years for them. But frankly, there's one other reason. And that's when money's at zero, full market return is not what it used to be, which is really interesting. So if we can deliver, 5 years ago, if we'd come out with a microfinance debt fund that had a 2-year window for liquidity and delivered 4% a year, investors would have said, well, I can get that in my money market fund, so why should I take the risk? Now that Ben Bernanke came out yesterday and said interest rates will be zero until 2014, major investors around the world are now paying banks to take their money. So interest rates are at effectively -3 with inflation built in. All of a sudden, 4% is a pretty good rate. And what's interesting is that while the US Treasury can borrow at zero, microbanks in Kazakhstan can't. So they're frozen out of a lot of the traditional credit markets, which means that we as impact investors can come in, can give them capital at reasonable rates, better than they can get in their local markets, and can pay investors a reasonable rate that is a full market return. So there's a whole variety of different dynamics floating around here, but I think that until this market needs to continue to mature, more investors need to have the same experience that we had in 2008 to really start reframing that risk discussion. Because again, the epitome of it is the riskless investments in 2008 were AAA rated, securitized, subprime, and it's still, and I was in the middle of that market in 2008, as many of you probably here in the room were. It's still amazing for me to think that if you make one really crappy mortgage to someone that has no chance in heck of ever repaying you, that's risky. But if you bundle 1,000 of them together, all of a sudden you get a AAA rating and it's riskless. So I think that as the industry moves forward and as more people become familiar with the themes, the geographies, the types of investments, the concept of risk will begin to diminish a little bit. And I think we'll be more in line with what the actual risk is instead of the perceived risk.
So here's what I'm hoping. I'm hoping we can invite you back in the 5th inning.
Happy to.
And see what's going on. Thank you
Happy to.
for joining us tonight.
So thank you.
Produced by Duke University. Online at duke.edu.